How's it going, everybody? Thank you for being here. My name is Antonio, and this is episode 2 of the 2023 Outlook series. And this one I am joined by Lyn Alden. However, who I am not joined by is your financial advisor. This is a conversation that is going to be general and impersonal in nature, one that will discuss high risk speculative investments, and one that will include a lot of forward-looking statements about events that may or may not take place in the future. Pause the screen and read the full disclaimer if you care about your money, if you don't like losing money. And if you do like losing money, just keep listening, I guess. And in the meanwhile, I will say thank you and welcome to Lyn. Thank you for being here.
Thanks for having me again. Happy to be here.
Yeah, pleasure is all mine. Pleasure is all mine. It's I guess it's been over a year since we last sat down. A lot has happened. So what do we maybe kick it off with a broad overview of the global economy? Last time I said, let's do a 30,000-foot overview as if we were in a helicopter. And then Lobo Tigre decided that it's funny to break my metaphor in two because apparently helicopters don't fly that high. But let's look at it from a 30,000-foot view. What are you seeing? What are you paying the most attention to in the economy and global politics?
Sure. So there's a couple key themes. One is that the United States and many other countries are purposely trying to suppress their economies to constrain inflation by basically modulating demand while trying to avoid an outright recession. And so we see basically decelerating economic indicators across a broad segment of different things. It started with manufacturing, is recently spread somewhat into services. We have an inverted yield curve in the United States. Basically, we have a bunch of recession indicators. Conference Board leading indicator looks recessionary, with the key thing that the labor market is still holding up strong, although that tends to be a lagging or coincident indicator. And so that's usually one of the last dominoes to fall. That's by the time you see that upturning, you're already generally in the early stages of a recession. And so that's kind of the place to watch. Somewhat opposing that, we have China reopening. Their lockdowns, you could almost consider them a type of recession. If you look at a lot of the indicators, at least to the extent that you can trust economic indicators out of China, generally when they're negative, you can trust that they're not good. They're not reporting negative things when things are good. And so we did see a lot of negative indicators out of China over the past year. Basically, huge slowdown in construction, huge slowdown in various resource usage. And that is somewhat reopening. We'll see how quickly that reopens and how much it's combined with stimulus efforts. And so that's kind of these two opposing forces. Basically, in the prior decades, sometimes you had China pulling the rest of the world out of slow periods, and we'll see if they're able to do that again.
That's a good overview. I actually have all of these things on my list that I wanted to talk to you about today, and that's also, it coincides with what Lobo has told me, that that's sort of the most important thing to look at, and global growth or contraction and how the China reopening is affecting that. What we've been seeing in the first weeks of the market, though, has been interesting. So before we go into every one of those points, or at least most of them, I want to talk to you about that because it's I heard something. Apparently, it's like an old saying on Wall Street or something like that, but it goes something like, as January goes, so goes the year, or something along those lines. Do you think that's going to ring true given the environment that you just described, or do you expect the bear from last year to wake up anytime soon?
So my overall base case is kind of a choppy, sideways, volatile market. I don't really have a strong conviction about a particularly bad year. Whereas I'm also not necessarily looking for new highs in, for example, broad equity indices in the United States. I think it is kind of a time for recovery for emerging markets potentially. Basically emanating around the China's reopening and kind of contingent on that continuing. But with those recession indicators, I think you do have to be careful in general about risk assets, and still treat this year very cautiously. Basically, people should be respectful of the yield curve and respectful with a handful of other indicators to say, until you see an uptick in some of those, you do want to be cognizant of a pretty high possibility of a recession. A lot of people, especially the prior two recessions in the United States and globally, have been particularly severe, right? So the 2008 crisis was obviously the biggest recession since the Great Depression. And the 2020 lockdown recession, I mean, by many indicators, I mean, that was worse, but it was just compressed. It was a weird type of crisis. And so people are used to these like catastrophic, outright deflationary recessions where everything just implodes. And I think the recessionary risks that we face are maybe more like older types of recessions, where it's not necessarily like everything implodes, but rather, it's an economic slowdown. And I think what makes this time kind of unique is that we have stagflationary forces. So we have supply side constraints in addition to, potentially stagnations in demand. And so I think that, I mean, ironically, one way to look at it is that many developing countries might have recessions that look more like emerging market recessions, where they encounter economic stagnation, but it's still around the margins inflationary in some aspects.
Hmm. Do you, because that's emerging markets that you're mentioning, is that like China dependent markets? Because I know that the US is not as dependent on China as, say, the countries around it are, or not even as dependent on China as the EU is. I believe we do more trade with China than you guys do. So
overall, basically, if we separate developed and emerging markets financially, I think the key thing to look at is whether or not the majority of their debt is denominated in their own currency. That's, there's, the official classifications when they look at these countries, they have all sorts of metrics to determine whether or not a country is developed or emerging. I mean, China right now is, one of the two biggest economies in the world, and it's still classified as emerging. And so, where's the threshold exactly? There's obviously different metrics. But financially speaking, the way that they behave is mostly dictated by whether or not most of their debt is denominated in their own currency. Because if a developed market like the United States, Canada, countries in the EU, Japan, when they issue debt, it's mostly in their own currency. They don't borrow in a foreign currency. It's pretty rare. Whereas a lot of emerging markets and frontier markets, they have to borrow in primarily in dollars. Also, to some extent, euro, if they're close to euro, like Turkey does, for example, and that makes it so that they have a mismatch between their revenues, usually denominated in local currencies, and then their liabilities, and so that can give them all sorts of squeezing. They're very subject to what the Federal Reserve does. Then there's also some like China, even though it's an emerging market, they're predominantly financed by local currency, although they do also have dollar bonds. So they're a little bit of a hybrid, but they're actually more towards the developed type of category. And the reason that some of these developed markets can experience emerging market-like phenomenon in this environment is that energy is like a currency they can't print, right? It's something that they need, but they can't print necessarily. And so, if a country has a debt crisis in its own currency, they can print more of that currency. It can be inflationary, but they avoid default. They can basically spread out that problem over time and space. Whereas that's why you see emerging markets default, is because they have liabilities and something that they can't print and that can be tightened outside of their control. And energy and resources kind of serve that same role during periods of acute shortages for some of those countries. And so Europe, in many ways, is going through somewhat of an emerging market style recession, where they have to shut down factories due to insufficient natural gas and electricity. And fortunately, they had a warm winter, so it is not as bad as it could have been. But they still have a big investment cycle ahead of them, potentially multiple years, in order to more structurally fix their energy problem. And so what we're seeing now is that because the dollar's kind of come off its highs temporarily, we are seeing a rebound in a lot of these emerging markets that were squeezed by the very strong dollar throughout 2022. And so as the Fed gets towards the top of its hiking cycle, as the US potentially enters recession, ironically, some of these emerging markets can, basically the boots kind of off their neck a little bit in terms of the dollar just screaming higher. And so I think that you could see somewhat of a divergence where emerging markets maybe do better than people suspect, even if the US kind of stagnates.
You said back there that those countries are basically subject to the Fed and what they do, and I mean their economic prosperity. And funnily enough, my portfolio last year has also mostly been subject to what the Fed does. And so I also wanted to talk about that, because you just mentioned that they're coming closer to the top of their hiking cycle. What do you, if you had to get more specific on that, do they go above 5%? Do they pivot soon? Should I be buying NFTs? I mean, I have a lot of questions here.
Well, so right now we're over 4%. Right now, the market and the Fed diverge on their views of what's going to happen. So the market thinks that they're going to get a little higher and then start rolling over, actually, in terms of their interest rates. Whereas the Fed is adamant that they're going to get over 5% and then stay over 5% for quite a while. So that's kind of a divergence. Historically, the market is right more often than the Fed. Usually the Fed has very poor forecasts of what it itself is going to do, ironically. Whereas the market tends to have a better forecast of what the Fed's going to do. But because these are pretty intense geopolitical issues and intense domestic political issues as it resolves around inflation. And so I think you get somewhere in the middle. I think the market might be too dovish and the Fed might be a little too hawkish. And so I don't, basically when you're already up over 400 basis points, I think, quibbling around the last 100 basis points is maybe less fruitful. So I don't really have a strong view on exactly where we line up there. And actually, another thing I'm looking at is the quantitative tightening. So everybody's focused on the interest rates, but they forget that the Fed is destroying tens of billions of dollars of base money per month now. They're doing quantitative tightening, and that is draining liquidity from the market. And it's very hard for the market to perform well when that's happening. Basically absent of either fiscal stimulus or quantitative easing. Over the past decade, that's generally when the market has stagnated or run into turbulence. And so that's still happening. And so I think that's actually the bigger question. And kind of to determine when they're going to run out of room there, I look at the treasury market. As long as the treasury market is liquid, as long as they're not having issues with bond issuance, as long as it's functioning, they can continue letting treasuries mature off their balance sheet. But I think by the end of the year, they're probably going to run into turbulence there.
Funnily enough, I learned that, well, it's not really funny, but I learned that from you about 2 years ago, that what you're talking about here, basically QE would be monetary inflation, QT would be monetary deflation, and monetary inflation has to be translated into asset price inflation or consumer price inflation, depending on the size of the QE, depending on the size of the monetary inflation. So it makes sense that QT matters as much or even more than the rates. But you are right, like the market does seem to be definitely dovish. When I look around at what people are saying on Twitter, when I listen to podcasts, people are saying stuff like, oh, no way, the economy breaks at 5%, we cannot go above it. But it's also funny because I've heard that before. I heard that we can never get to 2.5%. Then we heard that we can never get to 3%. Then nobody expected us to get to 4% inflation, interest rates. But inflation kept on, pushing higher, and the Fed kept on hiking the interest rates, basically. So what do you, I guess, first of all, to the first point, does the market break at 5%? Like, can we go and stay above 5% as the Fed is expecting? Like, is that even possible?
So I think we have to look at both time and space. And so basically the Fed's been able to get a lot higher than people thought, but so far it's been a pretty brief window. Right, a lot of debt, especially in the United States, but also many other countries, is fixed rate, meaning that just because interest rates go up substantially doesn't mean that everybody's debts suddenly get re-rated at that higher rate. So, for example, a lot of Americans have 30-year fixed rate mortgages. It's not like all those just re-rated higher. Only new buyers and basically people that are around the margins that are changing homes are subject to those new rates, and that's also why that they're not likely to do so. They're trying to hold on to their home as much as possible, or they're delaying a home purchase because suddenly those are a lot more unaffordable if you're getting out of an existing mortgage or starting a new mortgage. Same thing is true for corporate debt financing and the Treasury's own financing, right? So they have a broad spectrum of durations. And obviously those T-bills start rating higher pretty quickly, whereas a lot of their debt is longer term. The United States averages around 5 or 6 years of duration, but that includes, 1 month, and that includes 30 years, but it averages around 5 or 6 years. And so it's not just the question of how high you can get. I mean, if they raise it to 8% tomorrow, would it break tomorrow? I mean, there'd be crazy events tomorrow, but it's not like everybody just defaults tomorrow. But there's a difference between, say, going up to X percent for a month or going X percent for a year or 2 years. And then the second question to ask is, what is real yields, right? So, for example, you see countries like Argentina or Turkey have double-digit interest rates. but they're still below their prevailing inflation rate. So they actually have deeply negative real yields. And so even though the Fed's been very aggressive, they've not been very aggressive in real terms. Basically, the inflation was still pretty high compared to their interest rates. And the challenge there, of course, is that inflation is backward looking, while interest rates are present and forward looking. But overall, the way that I've been framing it is that they certainly can tighten. But what they can't realistically do, in my view, is normalize, which means that they get to a state of positive real yields and then hold that, for many, many years. I think that becomes kind of financially untenable given how much debt's in the system. But the higher that inflation is, the more they're able to raise rates. And the briefer that they do it, the more likely you can get to real yields, positive real yields on a brief basis, just because of how much is fixed. The problem is that quarter after quarter, more of that begins to mature and gets refinanced, and that's when it begins overall pressuring the system. So I think we have to separate what can you do quickly, what can you do in real terms versus what can you do in nominal terms.
I think a lot of people, when they are trying to decide what that is, would look at the past and would try and see, okay, what happened. Some people would want to reference the Great Depression, then they would move to the 40s or the 70s. And I know that you've often referred to the period that we're in right now. What you're describing, basically, you said that it reminds you of the 1940s. And then I've seen some people comment on your posts saying, but what about the debt? What about the household debt, for example? And debt to GDP is never been higher, and we're not producing. And demographics, something. And in the meanwhile, higher interest rates in combination with all that. So what do you specifically take from history to be, I mean, I don't even know how to ask this question, because it's like, how do you know that it's okay to look at history when we haven't really had the same situation before? I guess what I'm asking.
So I think you look at history as a guide, not as a perfect repeat. And if anything, I think the United States resembles the UK in the 1940s. And because back in the 40s, the United States was a rising power with trade surpluses. The UK was like a waning power with the structural trade deficits. And then they both went through an inflationary crisis. Obviously, that one was related to war and resource constraints. And what we're going through now is kind of a similar thing, except now the United States, kind of like how the UK was, and China is somewhat like the United States, but different, not as good demographics. So if you go back to the 30s and 40s, right, you had a gigantic private debt bubble up to 1929. That popped, and then you had this decade-long stagnation. And you had rising populism that fueled a lot of what eventually led to the Second War. And then in response to the war, you had absolutely massive fiscal stimulus in the form of military spending and mobilization and things like that. And so you flooded the system with money, which then flooded prices with price increases. But because public debts to GDP were so high, they held interest rates pretty low, despite the fact that inflation was double digits for many periods of time. I mean, inflation averaged 6% for a decade, with a high of 19%. In one of the years of the 1940s decade, and yet they held rates near zero, and they pegged the long end of the curve at 2.5%. And so another thing to keep in mind is that a private debt bubble collapsing is disinflationary. Money's being destroyed, and private entities are going bankrupt. They're also they're squeezing their budgets, whereas a public debt crisis is generally inflationary, because rather than default, they're more likely to print the difference. And so that's why you had 1930s disinflation and the 1940s inflation. And so in many ways, the 2008 crisis mirrored the private debt bubble of 1929. We had a big disinflationary crisis. This time, because there's things like FDIC insurance, because there's like quicker response times, they offset some of that outright deflation, but you still had disinflation. And then again, you had a decade of rising populism around the world, basically this period of slow growth, economic stagnation. And so when the economy got hit by COVID, if this had been an unlevered economy, you might not have seen the type of stimulus that you saw in this period. But because it's so levered, it's so fragile. The second that COVID hit, you had this massive injection of capital, especially from the United States, but also many other countries. And that was, I got people asking me things like, if you just looked at the charts, what would you think is happening? And I would say a war. It looks like wartime financing. It looks a lot like World War II spending, except instead of countries fighting a kinetic war, they're doing all sorts of stimulus efforts to try to, work around the fact that a highly levered economy is essentially shutting down for periods of time. And so, another thing is that in the 30s, banks were recapitalized. Same thing in the 2010s, banks were recapitalized. 2008 into the early 2010s, you had banks get recapitalized. And so, in many ways, we're resembling the 1940s. Now, it's different, like the ones I said, basically who has a trade surplus, who has a trade deficit. Demographics actually weren't amazing in the 1940s. Demographics peaked later in the 1970s. That was a very different type of inflation. That was more of demographics-driven inflation, as well as resource constraints. Whereas in the 1940s, you didn't have a lot of bank lending. You didn't have like a boom in population. Instead, you had a boom in fiscal spending. You had a basically a rapid debasement of currencies as all the different countries, fought over resources, fought each other. And so I kind of view the 2020 similar, hopefully with a lot less kinetic conflict, but basically similar types of wartime finance. And what makes it different than, say, the 1970s or different from other periods of time is that both the 40s and the 2020s have very, very high public debt to GDPs among developed countries. And so if they raise rates to 5%, 10%, and if they hold them there for many, many years, and all that debt starts to refinance at those higher rates, you run into a fiscal spiral. And in many ways, you start to look like an emerging market where you're pouring money into the economy. And so I think that much like the 40s, I think we're going to get waves of inflation. I don't think we're going to get all one. I mean, right now we're already in a disinflationary cycle, for example. But I do think that this whole kind of decade, from the early 2020s and then going into, say, the 2030s, I think we're in a more structural period of inflation, but that will be punctuated by periods of disinflation.
I guess all periods of high inflation are, right? Because you go through the waves and then you peak. Would you expect us to re-peak higher than what we did last time?
So I don't know about higher, because I don't know if you're going to get that same level of stimulus, right? I think that the sheer amount of money supply expansion within a 1 or 2 year period is going to be hard to match. But I do think that I think it's going to come from energy, from oil, right? So as long as there's an insufficient supply growth cycle, I think that's where eventually some of these spikes could come from, and they could last longer. And so rather than try to predict exactly what level that they're going to go, it's partially time and height rather than just trying to pick the height. Instead, it's more like I'm trying to predict the probability and the timing of when they might occur. And so, for example, the probability, in my view, is largely based on energy constraints, right? Unless we have some sort of persistent, terrible reduction in energy, which is usually not a good thing, then I think we're eventually going to get energy inflation again. Kind of like what Europe has seen for natural gas, but for oil and on a more global scale. And for timing, I think that's basically the next growth cycle. I think right now, we've been able to suppress energy and commodity prices by slowing down demand, and that can work for a period of time. But when we enter the next growth cycle, let's define it, for example, as purchasing managers index. That's like a good sine wave indicator of how quickly the economy is expanding or contraction. Next time we have an upswing in that, I do expect it to come a substantial amount of inflation, even though I wouldn't try to guess the exact height. Is it 5%, 6%, 7%, 10%, 15%? I don't really know. I think it'll vary by jurisdiction, depending on all sorts of details. But the point is that I do think we're going to have more of those waves of inflation.
I heard, I'm not sure if it's true or not because I didn't really look further into it, but I heard CPI is getting adjusted something next month. Like they're not going to be calculating it the same way that they used to calculate it over the last year or so, over the last period. Is that somehow related to what you're telling me here?
Not necessarily. So basically, one of the big controversies around the CPI calculation is whether or not the basket of goods and services that you calculate inflation from is accurate. And almost by definition, it can't be accurate because everybody's inflation basket is different. If you look at your spending, you look at my spending, we have different weights of what we spend money on, right? And so we're going to have different inflation baskets. And so what they try to do is have like an aggregate. They kind of research everyone's spending and they say, okay, this is kind of an average basket that represents the average person. And what is their inflation like? And then of course they use all sorts of hedonic adjustments and things like that. Um, they use kind of instead of house pricing going up, they use something called owner's equivalent rent, which is pretty like kind of a wonky calculation. And what they're changing is that they used to look at the past couple years of basically spending percentages to determine what their basket weightings are. So they say, okay, people spend a third of their income on shelter, they spend 10% on transportation, whatever the case may be. And when they're determining those weights, they look over a multi-year period, whereas now they're just planning on looking over a 1 year period. And so, for example, during the lockdowns, people spend more on goods, right? Because they couldn't fly, didn't go to hotels. Instead, you stayed at home and you bought electronics and you bought better appliances and you maybe expanded your home. Then everybody got that out of their system. Then when things opened again, when travel became less paperwork and less problems to travel, less restrictions, people traveled more, and so they started not remodeling their home, and they spent more on airplanes and hotels and things like that. And so this can determine what time you're looking at, right? So if anything, it makes it more service oriented than goods oriented. If you're only looking back 12 months and you're not looking back, say, 24 months. And so it certainly will affect around the margins, but it's not really part of my overall thesis. I think you have to look at more like what are commodity prices going to do this decade? What is the money supply going to do this decade? What is labor? What are average wages going to do this decade? I think those are the three kind of big buckets to look at, and calculations are just going to kind of move the goalpost around a little bit.
You mentioned commodity price and monetary supply, and all of this is sort of reminding me, even though I also understand that the labor market is important, we're also even seeing retirement ages being pushed up in Europe and stuff like that. But back to the commodity prices and the monetary supply, that's also interesting to me because you mentioned the war, and you said that if you looked at a chart without any context, you think that there's a war going on. Well, there is a war going on, right? And I've also heard the argument that that this is a war to dethrone the dollar. I've heard about de-dollarisation, weaponization then on of the currency on the side of the U.S. and other catchy phrases that are often reported simultaneously with something about a commodity-backed currency in some way. And to make my head spin even more, they even throw in the BRICS countries in there in these reports often. Is there a link there? Are the BRICS countries doing something that we might be missing that is related to the currencies and the commodity prices that you're expecting?
So I think there's a partial link. And to clarify about the wartime finance, basically when I was referring to that, that was even, people would ask me looking back in 2020 and 2021, if I looked at the charts, what would I say is happening? I would say it looks like a war. That was before the actual war that's happening now, basically. But of course, that adds to it. And one of the unfortunate things of war is that basically inflation leads to war, and then war leads to inflation, right? So it's kind of like if you ask people, why did World War I happen? Why did World War II happen? It's like, well, there's no one reason. Basically, these, you had rising powers, you had falling existing powers, and those came to a head. And things, of course, could have worked out differently, but they didn't. And they worked out the way that they did. And so, throughout the 1930s, you had rising populism around the world. You had various economic discontent. And when people experienced that, they tend to turn to more extreme views of things. And they turn to leaders that tell them, these people are causing your woes. If we go after this, we can make things better. And more often than not, those are often kind of cruel misdiagnoses of what's happening. But people believe it because they'd rather have someone forcefully tell them what the answer is than to someone kind of say, we don't really know the answer. It's a lot of answers. We have to work through this. And so economic stagnations tend to lead to more conflicts, physical conflicts, and economic conflicts and cyber conflicts in the modern era, things like that. And so In part, the United States has, we've been the global hegemon for quite a while. We control essentially the global reserve currency. Like I said, most emerging markets are basically financing their deficit, their debts in dollars in significant part, which means that we can kind of harden their liabilities whenever we want to, which is challenged. We can sanction, we can cut them off. And so there's a number of entities that would prefer to have their own payment rails, their own financing structures. And the biggest, of course, would be China. They don't want, now they're the largest commodity importer in the world. By some metrics, they're a larger economy than the United States. I mean, they produce more energy, they consume more energy, they have more skyscrapers, more people. If you look at a purchasing power parity, for example, they are bigger than the United States. And by some other metrics, they're still smaller. They don't have anywhere near the same military. They don't have the same nominal GDP quite yet, partly because the dollar is so strong. But basically, they're now rivaling in scale the United States, but they're still in many ways subject to dollar payment rails and buying energy in dollars. And so for many years they've had an interest in developing their own payment systems and being able to buy energy and commodities in their own currency. Same thing with Russia. They want to build a sale outside of the dollar-based system, and they want to be, they wanted to have their own. That's part of why they were stockpiling gold, for example. You can't freeze their self-custody gold in the same way that you can freeze their dollar or euro denominated assets. And so, on one hand, I do think we're seeing a rising of a multipolar world economically. So instead of one dominant superpower dictating and running the payment rails, I think we're seeing a more spread out type of power structure. So this goes back to World War II. When World War II ended, the United States had almost all the gold. Most other places were economically, physically devastated by the war. The United States was barely touched other than Pearl Harbor. And so they were basically over 40% of GDP, and they could dictate terms. But over time, as you've had a recovery in Europe, as you had a recovery in Japan, as you had the rise of China and India, now the United States is something like 20% of global GDP, a little bit more or less depending on how you want to measure it, nominal versus purchasing power parity. But either way, it's very hard to be that sort of unipolar hegemon when you're 5% of the global population, 20% of their GDP. It's a much more spread out world than it used to be. And I do think that our financial infrastructure is going to start resembling that. I think that there's going to be diverse payment rails. I do think that you could see kind of just alternate, currencies and payment structures. But I think, it's still going to be remain to be seen how that's going to play out. But what you have in common is that Russia, China, India, Brazil, many of them, some of them produce commodities like Brazil and Russia. Other ones are big commodity importers like China and India. And what they generally have in common is that they want to build a trade without asking permission of the United States.
All that I can think about right now, and that's mostly self-biased, I guess, because my portfolio is 100% in commodities, actually, is what does that result in? Everything that we've talked so far, what does that result in when it comes down to the commodities? And I want to talk about that. I think we have about 20 minutes left here, so if that's fine with you, I want to go over some of the commodities, some of the parts of the commodities market, and see what you're more bullish on. You already mentioned energy, but you mentioned specifically oil. What about the rest of the energy market? If we think about coal, natural gas, uranium, something that I'm very interested in. What do you think about that?
So I'm bullish on pretty much all of it. Uranium I've been bullish on since October 2020. It's had its ups and downs, but it's doing well. Natural gas is obviously a more local market, right? Because oil is pretty fungible. Barrel of oil is not that hard to transport. There's some anomalies, and there are a couple different oil pricing out there, but for the most part, it's pretty easy to move oil around, whereas it's much harder to move natural gas around. Which is why you don't really see a global price of natural gas. Europe's price could be 10 times higher than the United States price, for example, because there's very limited amounts that you can transport overseas, and it takes billions of dollars and years of new construction to increase that expansion. So you have kind of idiosyncrasies between the markets. I think a general trend is that in part because the Belt and Road Initiative that China is doing, more and more commodities are encumbered. right? So more like, China will make a deal. Well, they'll help a country kind of build out its refinement. They'll help build out its infrastructure. They'll finance it, and then China will get to right to buy 80% of their oil output, for example. And so that's part of the global calculation for how much energy is produced. But 80% of it, for example, is not flexible. It's kind of attributed to China. And so I do think that as more and more countries kind of fight over oil around the margins, it can be very hard to price the marginal barrel and to have any sort of flexibility as demands and supply come online and offline. And so I think that basically overall the result will be more volatility and by the end of the decade, probably notably higher prices in most of these types of commodities than we started the decade, is how I tend to look at it. And that includes, that's the full spectrum, right? So I generally fade parabolic spikes, right? So when natural gas went up 10x in Europe, I mean, would I buy it there? No. But I think that generally oil is, it's going to be chronically undersupplied. It's basically going to be something we're always going to be asking ourselves, where's the oil going to come from? There are decades where you don't have that problem, right? I mean, the past, say, 5 years, oil is pretty abundant, it's pretty cheap. It's not something you really had to think about. Whereas I think that there are going to be rolling 5-year periods where you have to ask, where's the marginal barrel of oil going to come from? And we obviously had to ask that question a lot in 2022. It eased by the end of the year somewhat, but I think we're going to have recurring cycles of having to ask, where's the marginal barrel of oil going to come from? And the same will be true for natural gas, coal, uranium. Obviously, that's a smaller market. It's a more complex market. And then I think it's also going to apply to things like copper and apply to other types of commodities as well.
When you talk about oil, and I'm hearing a lot about growth, basically, and growth out of China, and the oil trade is quite dependent on China, as far as I understand it. I haven't really looked too much into it, but a lot of it is also, and I guess why so many people like it is because a lot of it there's like a demand component to it, right? Whereas with uranium, for example, I've heard the argument that even if you calculate all the nuclear power plants that are under construction or planned right now, that's not too much demand if you stretch it along the time that those plants are going to be built. I mean, that's not too much demand growth, but then there is a severe supply constraint. So did you, and at the same time, what's been happening sort of last year is that the macro seemed to be holding uranium and uranium equities back. There was no easy money, basically, and those stocks are still stocks. Uranium stocks are stocks first, I guess, and they're risk on assets. So with not having too much growth, I mean, not having too much growth in demand for uranium, and also not necessarily having QE right now, are you still bullish on uranium equities as well, or is it strictly the uranium price, or do you expect maybe a decoupling? So, you're bullish on the price and therefore you're bullish on the equities. How do you see it?
Yeah, so I'm structurally bullish on uranium. It's not really a market that I trade. Basically, there's so many other things I'm focused on, whereas I don't really focus on uranium. What's uranium going to do over, say, a 6-month period? I basically look at the supply, I look at the demand, and I determine that essentially that I'm bullish, and I periodically revisit that thesis to ensure that nothing has changed. And so far, it's been I'm 2.5 years into that view, nothing's really changed. When I originally made the view is October 2020, and that was back when that was before Sprott acquired the Uranium Participation Corporation, and so it was trading at a 20% discount to NAV. And so my preferred way to do it was say, okay, well, I'm bullish on uranium, and if I can buy uranium for 80 cents on the dollar, I'll go ahead and do that. Obviously, that's obviously changed since then. It went to a premium, went back to discount. It's been, it's Sprott now manages it differently. Overall, I think for me at least, I like the risk reward of just owning uranium for the most part. That's kind of my speed. But obviously, people that are following the market quite closely, you can get much more explosive gains out of the equities. But you have to know what you're doing. Most of them are smaller capitalizations, other than the couple of big ones. And so I do think that as we enter a structural bull market in uranium, or I should say, as we continue one, I do think you'll get good activity out of the at least the well managed miners. But you just have to know what you're doing.
That's a big if that I missed last year. It's kind of funny, but it's painful too. If you know what you're doing, that's something that I didn't know. Apparently, and I should have stuck with spot and the well managed miners, as you said. You mentioned some of the industrial base metals, whatever you want to call them, I guess, copper specifically. Is there something else that you're looking into? Because I'm kind of interested in those obscure markets as well. Like tin, for example, is starting to get up high up on my radar, just because of how small that market is and how explosive it could be. But there's also other metals, industrial metals. Are you looking at anything else besides copper?
Not too specifically because when you focus on a lot of things, there's certain
Mhm.
small markets that you just have to kind of accept that you're not going to be able to follow closely.
Yep.
And so, for example, the past couple of years, I have heard about the opportunities in tin, and it's just something that I've said is probably correct. It's just I don't have the bandwidth to go into the nuts and bolts of what's happening in the tin market, and so in general, when you have commodity bull markets, there's a lot of macro forces behind it. Usually, it's kind of a weaker dollar. It's usually associated with more emerging market growth because that's of course where the marginal demand for most commodities comes from. And you have this kind of natural capex cycle where you go for a period of time of underproducing until you get a price squeeze. Then the price squeeze triggers more production. You eventually get to overproduction. That's when you get the next bear market. Weak production for a while, and you kind of go through these 10, 15, 20-year cycles. And a lot of those commodities kind of go along a similar route. They might not spike in the same year, but generally good decades for commodities or bad decades for commodities tend to impact the majority of commodities. And so my overall approach is to kind of have a scattershot, diverse commodity exposure, especially to the big ones like the various energy and copper. I also like fertilizers. I like kind of a broad array of commodities. And I'm not, when it comes to smaller commodities, I think I would leave that to people that focus every day specifically on the commodity sector. They have more time to dedicate to those small markets, and the advantage there is that they can find things that a lot of investors are not looking at.
Hmm. So yeah, that's true. You got to be focused on that though. It makes sense. What about, because you're talking all about commodities specifically, and I mean broadly, does gold and silver, um do they count as commodities for you, or are you seeing them mostly as some people would say they're money, or they have more of a monetary value and therefore they move differently. And but gold has already also had a good move this year actually. So where do you stand on the precious metals?
Well, so they're hybrids, right? So they have a monetary premium and they're also used for some commodities, especially silver is the hybrid. Gold's more of a closer to a pure monetary type of asset. So I do look at things like the copper to gold ratio, for example, or the oil to gold ratio. Generally, of course, you'll get gold outperforming during decelerating economic periods, and then you'll get other commodities outperforming during rising economic periods. They could obviously both be going up or down together, but generally the ratios at which they're going up or down will be impacted by whether or not the global economy on average is accelerating or decelerating. And so, there are years where I might favor gold over copper, another year where I might favor energy. So, these things are mostly going to be cyclical timings. I'm generally bullish on the whole complex, including precious metals, most likely for this decade. The precious metal story obviously is a little bit different of a structure. Rather than focusing on the lack of capex, instead I would focus on that's more of a demand story. And so from the 1970s all the way to 2008, we generally had declining global reserves of gold. Basically, these countries had gradually reduced their gold holdings. They were holding more treasuries. Starting in 2008, that trend reversed. So you fell from something like 37,000 metric tons to 30,000 tons of official global reserves of gold. And then since then, we've built back up to the high 30s again, something like 37,000. I haven't looked at the exact number recently. And we've had very big gold purchases, late last year. And I think it's going to continue. I think it's part of the multipolar world thesis, where instead of holding a lot of dollar or euro denominated assets, I think a lot of these BRICS nations and BRICS plus, these a lot of emerging markets in general are going to hold a more diverse array of reserves. And that, for some that do a lot of trade with China, that can include a little bit of yuan around the margins, but it can also include a lot of physical gold that they buy and that they custody.
I think I listened to Luke Roman, must have been Luke, yeah, who said that the gold for oil trade is sort of inevitable. Like he said, it was like that in the past for a long time, and it's definitely going to be like that in the future again. Would you agree? Like, is that doable even in this economy?
So I think it's a reasonable way to look at it. It's kind of like if you're measuring something with a yardstick that's always like expanding, right? Then what you're measuring is going to keep changing. And so, for example, if you look at the price of oil in dollars or in a weaker currency, and you look at the price of oil in, Egyptian pounds, for example, over like a 50-year period, you're going to get this big, long-term rising pattern. It'll go through periods where it chops along and goes down, but it's going to be this rising thing. Whereas if you look at gold, oil price in gold, it's generally it's bounded. It basically just chops along sideways for a century essentially, and that's because obviously both are there's only so much that are produced in a given year. There's only so much that are stockpiled. For gold, the stockpile matters more, whereas for oil, the annual flow, the annual production matters more. And I do think that's probably going to continue to be somewhat range bound. And I do think that if you're an oil producing nation, you're selling something finite, something that, takes a lot of capex to produce, that basically represents a form of savings if you leave it into the ground. You generally don't want to trade that for paper, things that just lose value and you hold that for a decade, right? You want to exchange that for either infrastructure, right? You want to get money and then spend it on something more tangible, or you want to hold it in something more durable, which could be gold. And so, for example, in the 80s and 90s, U.S. Treasuries had positive real yields, substantially positive real yields, meaning that their yields are much higher than the inflation rate. And so, if you're Saudi Arabia and you took your oil, sold it for treasuries, held the treasuries, you did quite well holding that over a 5, 10, 20-year period. Whereas now, over the past decade, T-bills have been below the prevailing inflation rate. Longer duration have often, they've been at or below roughly the inflation rate. If you measure the inflation rate probably a little bit more appropriately, they're probably an average a bit more below the inflation than many of those metrics would imply. And so if you're a lot of those countries, you think, why would I want to sell, something that's scarce, something that's valuable, something that takes a lot of resources for something that can be infinitely created, something that is not maintaining purchasing power over, rolling 5, 10-year periods anymore. And so I do think you'll probably see, just structurally more interested in holding gold as reserves, probably.
Is there anything you're more bullish on besides the commodity complex? I know in your service newsletter you follow, basically you have this heat map of the whole economy in the different sectors. Is there anything that stands out to you more than commodities?
Well, I think there's different time frames. I'm less bearish on banks than most people seem to be. Banks actually, this goes back to the 30s and 40s comparison. That basically banks already had their big capitulation. They've been recapitalized, and now banks are actually have pretty strong balance sheets. And a lot of these deficits that you're seeing from the Treasury or even the Fed now, a lot of that actually flows into bank bottom lines. And so I'm actually not, I'm not that bearish on banks the way that many people seem to be. I also like energy pipelines. You're not really subject to the commodity pricing, but a lot of them are cheap. A lot of them have already had, multiple rounds of leverage blowing out. A lot of them reached their peak back in like 2014. They've had a terrible, bear market going all the way into 2020. But I think a lot of that's washed out. I think that a lot of that is, it's high yielding. It's more conservatively financed now. The industry is more self-financing. And so I'm pretty bullish there longer term as kind of an income play. Like I said, I generally like emerging markets in general. That includes kind of, not just their commodity sectors, but their other sectors as well. And I also, I invest in Bitcoin. I also do some venture capital investments to kind of, help build startups that are building on top of the Bitcoin network. And so that's kind of a side thing that I do with my other portfolio. And so I like the combination of having some of these dividend paying companies, whether it's banks, whether it's pipelines, whether it's healthcare companies, for example, paying out regular dividends, while also then, getting into commodities, getting into more volatile investments.
So you're talking about commodity companies, dividend paying, and also something with a stronger macro wind behind it. What about something like Calmain Foods? I know you not necessarily wanted to discuss individual investments here because you do that in your service again, but egg producers and poultry producers, they had a good year. I mean, Calmain Foods, they had a decent dividend last year, 50% upswing. Do you think the risk, given the bird flu and all that, is too high for these companies right now?
So I haven't looked at the industry recently, so I would be kind of guessing. I would have to spend time to research that. Overall, I do think that the agricultural sector, longer term, is still going to be interesting this decade. And I think that it'll come and go. There's generally faster reinvestment cycles. I mean, you can fix a grain deficit, for example, faster than you can fix a copper deficit. Same thing with fertilizer. These different types of agricultural products. But I do think that a lot of them are going to do pretty well this decade. And you have to, again, just like I can't necessarily follow the tin market, I can't necessarily follow the poultry market closely. But sometimes these things get on my radar, and then I end up following them pretty closely. So it really kind of it's hit or miss.
For some reason, I started following the egg market this summer, sort of as a joke, because I did this like weekly show, and I was making some kind of a joke about eggs, and then I started following it, and it's been sort of out of hand.
Yeah, they've been
Ever
spiking.
since.
Yeah,
It's been
partially
spiking,
because
yeah.
partially because of that bird flu.
Yeah, indeed. I didn't make any money on it, so there's that, unfortunately, but at least it was kind of funny to follow. It's quite high now, though. I'm also about to let you go here. Maybe a weird question here because it's probably not as fitting for you, but I made a video sort of going over my mistakes that I made last year because I lost almost half of my money last year in the markets. And I wanted to ask you, do you still make mistakes in your own investing and in your trading? And if you do, what is a mistake that you made last year?
So everybody makes mistakes. I make mistakes. One of the mistakes I made over it was kind of 2021 and 2022. I think the mistakes were made in kind of the second half of 2021, which was that after a lot of those growth stocks, like the ARC stocks, after they fell a lot, I got interested in some of them too early. Basically, and that's kind of leads to my next stake that I did partially underestimate how tight the Fed would be able to get. Right. So, for example, I was not one of those people saying that they'll never be able to tighten. My view is always they'll be able to tighten but not normalize. But for example, if you asked me if they would tighten by 4% in 1 year, I would have taken the under on that, right? And so and that also is a huge valuation impact for growth stocks. And so after during the whole ARC mania, I was like, okay, that's a bubble, I'm not touching that. After they fell a lot, I was like, okay, now some of these maybe are interesting. And then of course they got killed again. Basically, it's like the dip kept dipping. Now, I think the way I approach it is, we're all going to make mistakes. So I just try to make my mistakes not that big, right? So for example, I didn't over allocate. I kind of just dabbled in some of these growth stocks that ended up just being too early, just not the right time, not the right valuation. And so I had to take some losses on those. And it just came down to managing position size, basically balancing that compared to, pipelines doing good, healthcare stocks doing good, basically other parts of the portfolio. And so I've certainly I made mistakes the past couple of years. I'm going to continue to make mistakes, and my overall attempt is just to get more right than I get wrong. And then specifically, even when you get things wrong, to cut them, or at least like minimize the size of those mistakes. If you look at some of the best traders in history, like let's say Stanley Druckenmiller, he's arguably the best trader in history. He's right like something like 60% of the time. And he's the Tom Brady of trading. So if you look at like another really, really good trader, they might be right 55% of the time. And so what makes them the best is that, you're right a little bit more than you're wrong, but then also times you're wrong is limited. And the times you're right, you double, triple your money. You basically it's not just what percentage that you're right, but it's about risk reduction when you are wrong.
I'm about to let you go here, Lyn, because I know that you have to go. I just want to go over some of the points that you made that I thought were important, and you tell me if there's something you want to add or something that I missed there. Most important topics that you mentioned was generally sort of like global growth or global contraction, and the China reopening and how that affects the whole thing around it. You don't have a strong conviction for a bad year, but you're not expecting new U.S. highs either. You're mostly looking for recoveries in the emerging markets, the growing markets. You said the market is too dovish, the Fed is too hawkish, so you're possibly expecting something in between. But in terms of inflation, you're expecting us to. You say that inflation depends on how much stimulus there is in the system, but a period you're expecting generally a period of higher inflation than what we saw, let's say, in the last decade or so. And this might not have been the ultimate peak that we just saw right now. Because all of this resembles to you 1940s in the UK, where the UK was sort of no longer this powerhouse that it was before, and the US was becoming the new power in the markets. An important quote that I took out was inflation leads to war and war leads to inflation. And based on all that you told me, you're bullish on generally the whole commodity complex, but the energy more specifically. Does that sort of resemble what you told me here today? Is there something you want to add?
I think that's a good summary. I think the only thing we can add to that is timing, right? So I think that, again, the way I would describe it is that structural inflation punctuated by periods of disinflation, and that clearly at the moment we're in a period of disinflation. So inflation indicators are rolling over both on the annual and the monthly way of looking at it. Money supply has had one of its rare contractions. So usually money supply goes up every year. Over the past 12 months, it's like flat to down, partially because of all this tightening that's happening. And so basically, as long as the Fed is able to reduce its balance sheet, as long as there's adequate liquidity in the treasury market, as long as economic indicators are rolling over, I do think you're going to get this ongoing period of disinflation until there's a pivot, until there's a change, until there's say the treasury market goes illiquid, the Fed has to step in, or until there's a recession, and then there's the Fed says, okay, we're going to pause, we're going to start cutting, we're going to do X, Y, Z. And then again, it's also very contingent on what China does. That they could make it less disinflationary than it otherwise would be, because they could ramp up, say, their oil demand at a time when the United States is trying to suppress inflation. So there are timing nuances here. So essentially, I would say that 2023 is a really uncertain year, potentially a disinflationary year, but that when you look out to the next growth cycle, I think we are going to likely get a return of inflation.
That's a very, very good overview. I thought this was a good discussion. I don't think I have any other questions, and I really appreciate you investing your time with me.
Yep, thank you.